You're all very welcome to the Tourism NI webinar on cash flow for small businesses. Let me start off by acknowledging the difficulties all of you are facing during this challenging period, but I'm deeply encouraged by the resilience and agility that many of you have demonstrated. During this period, for instance, within a few days' notice, many of you have quickly transitioned to work from home to ensure compliance to government guidelines and ensure business continuity. Some of you have re-engineered your business, experimented with new products and services, looked at innovative ways to save costs. A lot of you have investigated and applied for a range of government support available, often navigating complex eligibility and application requirements. Some of you have completely transformed how you do business. For example, for the very first time, you've developed an online presence, integrating websites to inventory and payment platforms. Now, this tells me that the fundamentals of the business and the economy are robust. The crisis is certainly forcing businesses to take a hard look at every element of operations. This will certainly have a positive impact on your business when we're out of this crisis. But we will need to tread carefully in the next few weeks and months and perhaps years to ensure that your business and brand is shielded. It is also important to ensure that the comeback is stronger than the setback. Now, and probably that's why cash flow forecasting is very important. Cash flow management is essential during this crisis. And of course, if you fail to plan your cash flows, you can plan to fail. What will I cover today? The first thing is to go through the objectives of the webinar. I will talk about how COVID-19 disruption is affecting your business. There are sometimes a couple of things that you would have missed or the impact that you would see only in the future. So I'll talk about some of those red flags that you'll need to consider well in advance. I will give an introduction on the fundamentals of cash flow forecasting if you've not done it before, what it entails, and just give you a foundational understanding of what a cash flow is. And of course, the heart of today's workshop would be building a cash flow model from start. So hopefully at the end of today's session, independently, you will be able to build a cash flow forecast. So I'll put years of my experience in cash flow modeling, and I'll give you tips and tricks and practical advice on how to go about cash flow forecasting. And of course, I'm not sure how many of you have used the Tourism NI COVID-19 financial modeling template, which me and my team have made. So it's up on the Tourism NI portal. So again, I will just run through that and probably just discuss how it can be used and updated. Now, what are the objectives of the cash flow forecasting of this workshop? Number one, help you build a simple cash flow independently using Microsoft Excel. Now, I've always said that a good cash flow model has the right balance of simplicity and complexity. So hopefully, again, there's no one size fits all. So you have to find that balance. So hopefully I will give you some guidance and signpost you on the best way to build a model. And of course, the objective of this exercise today is to help you plan your next steps by ensuring adequate liquidity, right? Liquidity is cash in the business. Now, of course, all of you are facing cash flow challenges. There's no doubt about that. And of course, there are a lot of government-backed lending support that's available. This hopefully will help you decide how much to borrow and also calculate the peak funding requirement. These are concepts that I will run into as I go through today's session. The next objective for today is explore how to use cash flow forecast to plan various scenarios, including extended disruption period. So I will be running through how to build a model, but at the same time, how to sensitize it. What are the different techniques that you can utilize to change the numbers to see what the best and the worst case scenario is? Because as we all know, this pandemic is uncertain. We do not know when it'll end, how long the social distancing measures will be there, when they will be lifted, how long restaurants will remain closed. So it's very important to plan for various scenarios, because especially when you borrow, you should ensure that you have the capacity to repay them. And if you're making commitments to purchase and buy equipment, you'll need to ensure that you've got enough money and enough liquidity to honor those payments. So I will be running through some sensitivity based tools that you can apply on your cash flow model. And of course, the most important thing and the objective for today is to empower you to successfully navigate the COVID-19 disruption through cash flow forecasting. So that's the objective for today. We've covered certain topics in the previous webinars, and we would not be going into a whole lot of detail on that today. Some of the topics covered are business resilience and leadership in a crisis for tourism businesses, approaching banks and other funders. We've talked about government-backed lending and supports available in Northern Ireland. We've talked about working capital and cash flow management. Now these webinars are available on the Tourism NI portal and YouTube. So how does COVID-19 impact your cash flows? Now, obviously, the first one's an obvious one. There's been a decline ever since the lockdown was introduced somewhere during March. And there's been a significant impact on your business, on current sales, future sales. There's been an impact on various elements like debtor collection. So obviously, a lot of your customers, tourism businesses generally get, a lot of them do get cash up front, but you might have a lot of corporate clients and probably you're facing delays in collection because they're all worried about their own cash flows. There could be a reduction in supplier credit. Now we're facing this more and more now where suppliers are refusing to supply unless they get a part of that up front. So that can completely change your cash flow and your working capital mechanism. There's an increase in cost for certain materials, a lot of them due to the supply chain, the natural impact on supply chain, things are getting more expensive. Of course, the increase in cost to facilitate meeting social distancing requirements. Now, obviously, this is evolving very quickly. There's government guidance that is constantly being updated and requirements which we'll know very soon. But looking at different other countries and what they've done, especially for restaurants, we know that we will probably have to work on an arrangement or where, for instance, if it's a restaurant, there has to be a minimum distance between tables. So obviously this will add to the cost of operating. Forex rate volatility, there's another point that we've seen. For instance, we've got a lot of customers, clients who are getting supplies from America. And of course, due to the devaluation of the pound, to some extent, their imports are more expensive now. There are some delays in receiving, well, grants and supports have generally been coming on time, but in terms of loans and getting them on time, there have been some issues faced by certain businesses. Stock holding, of course, a lot of clients have invested into building up their stock levels before, just in anticipation of the peak period, but unfortunately they're not able to sell them and dispose them. So there's a huge stock holding cost attached to it. And of course, there are also issues with inventory management, the fundamentals of cash flow. So just to give you an overview of what cash flow forecasting is and what cash flow is. Firstly, it's important to understand that cash is not profit. Cash is the amount that you have on hand at a point of time, right? I know it's so simple. It's such a simple concept. But sometimes you're so lost lost in terms of running the business that you don't really recognize that these are two different concepts. Cash is the amount that you have at that point of time, but it could belong to someone else. So which leads me to the next point, which says that you can be showing a good profit on the books and still be strapped for cash to cover immediate debt. So there could be an issue there. Now the cash flow the fundamental principle, the rule of thumb, if you may, for cash flow management is it's speeding up the inflows and slowing down the outflows. That is the fundamental principle, and you already know that it's a very logical thing. But you'll also have to remember the next point, which is very critical, that delaying payments and borrowing heavily can create problems for the business. It's kicking the can down the road. So it's very important that you remember that delaying payments and borrowing heavily will result in a bigger debt for the future to service. So it's very important that you sort of balance those 2 points. Now, of course, cash flow forecasts are only as good as they are monitored and amended and updated at any point of time. So once you make them, you'll have to continuously monitor and amend them as you go along. What's the first step in a cash flow forecast? You'll need to understand your opening position. You'll need to know what your bank balance is. You'll need to know what your debtor balance is, how much is receivable. You'll need to know how much is payable to your suppliers. You'll need to know your fixed asset position, your inventory position. So now I do understand that not everybody has real-time accounts in the sense that they don't have a balance sheet prepared. How it normally works is they will trade, they'll have a grip on cash flow statements, they'll have some sort of records on sales, so they'll keep a track on revenues month on month. But at some, and as the year progresses, they'll get in touch with the accountant. They'll give them the books and records, and the accountant comes back with the balance sheet and income statement. Now, because of the very unique position that we're in now, it is, I think real-time accounting information has become a need for the hour. So this is a sample balance sheet that I pulled from my client yesterday, last night, actually. It's the 17th of May. Now, he's implemented a cloud-based accounting package where on a real time, he gets to see what the different balances are. Obviously, these are not updated every day, so they might be running 1 or 2 days behind. But at the same time, at any point of time, he knows how much cash he has in the bank, and that's automatically connected to your bank accounts. That gets updated and reconciled. The invoicing is through this accounting package as well. So very quickly, he was able to build a cash flow forecast. So that's your starting position. Now, if you don't have a balance sheet, what I would suggest is try and understand those big balances. Think about your cash flow, think about your cash balance, think about your debtors, think about your creditors, your inventory. And if you can understand what those 4 balances are, then it's a very great starting position. Now, assuming that you have got the balance sheet, right? The first thing that you do is list them out. So this is the balance sheet from the accounting package, and it's the 17th of May, running through the different types of balances. They've got balance and fixed assets. There is some cash. There's a large amount receivable. There's a large amount of inventory. There's accounts payable, which is a significant number. There's some PAYE that's payable. There's a big VAT bill that needs to be paid as well. And of course, that's the share capital. Now, the very first thing that I do is sort of take the opening position and plan for the next 2 or 3 months and understand how those balances will be settled, right? So let's take fixed assets initially. Total tangible assets. So this business has tangible assets worth £952, right? But they know that they have to spend, in month 1, they have to spend £2,200 for laptops and hardware. So as an easy way of doing things, I would put a note there which says 2 laptops and hardware required in month 1. This is just for reference as we build the model, and I'll come to how we use the notes later. There's some essential office maintenance that needs to be done of £5,000, so that cannot be postponed any further. So that's the £5,000. There is accounts receivable. Now, the business owner has made a judgment call, or based on his discussions with his customers, he believes that he's going to receive 20,000 next month. So out of the 81,000 due from customers and clients, there's 20,000 that he'll get next month, 25,000 in the month after that, in month 2, and 30,000 in month 3. And now he's again spoken to his suppliers, spoken to his customers, and he believes that the balance is not recoverable. So that's a judgment call that he's made. Inventory is expected to remain the same. Again, no movement there. Accounts payable, now again, there's 150,000 due. So about 40,000 is expected to go in on month 1, and on month 2, 60,000 is expected to go. So that's how the opening balance is expected to be cleared. Now, the balance we've assumed will remain fixed. So it could be accounts payable relating to a related company, or transactions which are part of the balance sheet, but you don't expect that to be settled. It could be a director's loan, I don't know. So only 100,000 is expected to be settled. And of course, VAT, there is time to pay arrangements. So there is VAT payments are deferred, as you would know. So any amounts which are due during this period can be deferred up to March 2020. And I would encourage you to read the guidance on that. But that's a comment that I've updated. So capital and reserves. So the business owner has made an assessment and doesn't want to borrow high amounts of money unnecessarily, and knows that the owner has 20,000 of personal funds to spare that can be put into the business to ensure that it sustains. So that's a note that I put in as well. Other notes in terms of you've probably furloughed staff. So make a high level assumption on what you're expected to receive and how long you're expecting to receive it. So that's the starting position. you've analyzed what your starting position is in terms of your balances, and you've made a plan on how to settle that opening balances. So if it's debtors or creditors, you've sort of planned in your mind how you're going to pay them over the next few months and which month that'll be settled. You've also made some estimates on some capital expenditure, some things that you can't really postpone for beyond a month or so. So you've sort of made high-level estimates for that as well. Right. Step number 2 is to open an Excel sheet. And I'm sure all of you have this, right? So I'm going to give you I'm going to give you a tutorial on how to build an Excel spreadsheet from a blank spreadsheet. So this is where all of you will start. Now, the cash flow has 3 parts, right? There's inflows, outflows, balances, right? So inflows are any amounts that come in, right? So what are the different kinds of inflows that you may have, right? You'll have inflows from sales, right? You'll have opening debtors. So remember we spoke about the opening balances here and when they're expected to be received. So that'll need to be updated here. There's owner's equity or director loans. That could be a potential inflow. There's the coronavirus job retention scheme. There is any grants. There could be potential loan drawdowns. There could be some VAT refunds. And of course, the total. So that's the first step, to understand how are you getting money in, right? What are the different types of income that you're receiving? Now, I would encourage you to note these points down because it's very easy to miss 1 or 2 of them. So if you can, write them down. These sessions will be recorded, so you can always go back to it, but nothing beats taking notes. So if you can, I would encourage you to do that. So that's on the inflows. Outflows. What are the outflows of the business? And I'm sure you know this very well. The first thing is the cost of sales. So any purchases that you make. There could be any opening supplier payments. So if you remember going back to your opening balance sheet, we went through an estimate of the opening balances and when they're expected to be settled. So that's that'll need to go in here. There is salary costs. Obviously, that is a big number, but it'll be offset by the coronavirus job retention scheme income that's coming in. Yep, you've got the admin costs. So any administration overheads, you need to put that in. The marketing costs, very important. You've got other costs, anything else that is neither admin or marketing, those can be added on. VAT payment, and I'll come to this in a moment because I think that's an area that needs a special focus in these times. And of course, your fixed asset purchases. And at the very end, loan repayment, right? So this will give you a total list of all the outflows. Now, again, I would encourage you to write them down. So you just made sure that you've not missed any of the outflows. Now, if there's anything that's very unique and specific to your business, please add them on. So we've looked at the first part, which is inflows. The second part is outflows. The third part is very important. It is the movement in balances. So you've got the opening balance, which is your opening cash balance, and you've got your closing balance, right? So what I would also add a line in here saying net movement. Net movement is nothing but your inflows minus outflows. So the formula is quite simple. You've got your opening balance, which is adjusted by the net movement, and you get the closing balance, right? So I hope all of you are with me so far. Now I'm going to tell you how to spread that across and how to make a rolling forecast for 12 months. The first thing that you'll do is, again, a lot of businesses operate on a weekly basis, you know, in terms of wage payments. Now, in my experience, weekly forecast can be incredibly complicated, and it's very difficult to estimate. So I would say stick to monthly as much as you can. But if you need to go to a weekly basis, you can. You can apply the same principles that I'm telling you today and roll that across for a weekly forecast. So the first thing is to write the date in. So I'm going to say June 2020, right? So now this is an Excel tutorial right here. So if you bring the cursor to the bottom right, you'll see a plus. You can extend that for 1 year. So that would take us to May. There you go. Yep. So that'll give us 12 months. So that's how we plan the forecast and we plan ahead. I'm going to make that bold. Now you'll need to make an estimate of all the numbers, right? I'm going to put in some numbers here based on, again, a case for one of my clients. So now, obviously, we're expecting this to continue. So let's assume that June 2020, there's no sale, but things will slowly pick up. And there's 50,000 coming in month 2. This will get expanded. And in October, that will double and you'll get 100,000. So one tip would be to add commas. So you can select this entire field and click on the button here. And so you'll have numbers with commas. So let's assume that the monthly sales increase to 100,000. That is expected up to December. There's 125,000 monthly that comes in after that. That is expected to continue up to April, and it's back to 175 that you've estimated, right? Now your opening debtors, right? So going back, we've made some estimates here. So I'm going to put them in: 20,000 in month 1, 25,000 in month 2, and 30,000 in month 3. So I'm going to put that in. Owner's equity, I'm going to put that blank, but feel free to put that in. Let's assume there's a job retention scheme income for the next 2 months. So let's put that here, right? Now, this is the sum total of your inflows. This is what you expect to come in, right? So the easy way to add them up is you can do equal to SUM, type that out, open bracket, and just select this. And then press enter. There you go. So that's a total of your inflows. So you can take that, again, the plus, and you can drag that across here. So all your amounts are available side by side. I hope you're with me. So this is an estimate, your estimate of the amounts that come in. Now, your outflows, cost of sales, the easy way to do this is assume a specific margin on your sales. So for instance, if you know that you make a 45% cost margin, or there is a 45% cost margin, just because your purchases are, from a fixed margin historically, you can, on that basis, take this amount, multiply into 45%, right? And then you can again take that formula and drag it across. So, which means at any point of time, your cost of sales is 45% of that. Again, it's a very high level estimate. And it's, of course, very unique to your business. Opening supplier payments, again, you'll have to go back to your opening balance sheet, and the numbers are 40,000 in month 1 and 60,000 in month 2. So we'll put that in. Now, your salary cost, again, since we've put the amount recovered through the job retention scheme, since it's shown, it's not netted off, you'll need to show both of them. So you'll need to show the amount coming in and the amount going out. So this would be a total salary cost, and that'll be 15,000. And I'm going to put that in here. Admin cost, you can make an estimate. I'm just going to put some numbers here. And I'm assuming that at some point the admin cost increased slightly. So there you go. Marketing costs, I'm assuming that you've probably stopped marketing for a period of time. I'm just going to freeze the cells here so it's easy for us to see the months. So marketing costs, we're assuming that you'll only start spending at some point of time. So let's say it's 2,000 a month, and it starts here. Other costs, we'll leave it at nil for the moment. Now, VAT payment is something that you need to keep an eye on. I mean, you know, the amount of times we've spoken to businesses where, you know, they've seen the cash in hand, but just because they make a quarterly payment, they haven't really set aside some money to pay their VAT bills, and they've bought these fancy new equipment. So I think it's very important to keep an eye on the VAT amount, and especially since there is a deferral arrangement, it's very easy for that payment to get missed. So, and again, for this company, it's such a large number just because of their trading and their export sales. So you'll need to put that amount in here, 78,140. So I'm going to put that in there. Fixed asset purchases, if you remember, we'd made some assumptions on that in the beginning. So 2,200, 5,000, there you go. And then, of course, the total, right? So I hope all of you are with me for that. And there you go. So that gives you an estimate of total inflows and total outflows. So you've really mapped out your next 12 months. You've sat and thought about every amount that should come in your very best estimate. And you've thought about what's coming in and what's going out, right? The next bit is to look at the net movement, which is a simple formula, this minus this, all right? Again, you can take that and drag it all the way across here. Okay, interesting. So now coming to the third part. So we've looked at the inflows, we've looked at outflows, the last bit, which is very, very important. Opening balance. What is your latest opening balance? Again, if you don't have a balance sheet, you can look at your bank statements and you can make an estimate of that. Right. The opening balance here is 59,793. So I'm going to put that in here. 59,793. So your closing balance is your opening balance plus net movement. Okay. Now the opening balance for the next month is nothing but your closing balance for this month. So you can just do equal to and then bring that there here. Now, very easy thing to do in Excel. Take that and drag that formula across, right? And then the formula here, which is your net movement plus opening balance, take that, drag that across here, right? So you have a very good estimate of what your closing balance is going to be across various years. So that is the product of, now again, have a look at each amount again, go back, see if it's sensible, see if these amounts make sense based on your knowledge of the business and what you've seen historically. You can amend them, you can correct some numbers. Now why this is so important is you can actually understand, you can actually have a look at the forecast and try and understand which months you're falling behind on your balances. So for those months, you can adjust your costs and just make sure you don't spend that much. What I would also like to say that this is on a cash basis and not an accrual basis. So it's not, it's when there is movement in money, and it's not necessarily when the sale was made or when the item was purchased. So that's another thing to keep in mind. This is an entirely purely cash flow led model. Now, what is our analysis? So number one, like I said, you can estimate the various the different transactions in each month and try to adjust how you're spending money, what you need to bring in, and what your target sales are for each month, right? You can decide how long to furlough staff, bring them in, bring them out, because the calculations will automatically flow. The next bit that I'm going to tell you is actually quite important because as you can see, there is a negative balance here of 30 grand, which needs to be funded. There is a closing balance of 77 grand, which needs to be funded here. So that's potentially a huge cash flow issue, which perhaps needs to be funded by a loan. So again, you'll have to talk to your bank, but I'm going to show you a very easy Excel trick on how to calculate what you can afford to take on as a loan, right? So this is a loan installment calculator, which is based off an Excel function, right? And it follows a very easy set of steps. The first one is the amount. So you'll need to put in the amount here. You'll put in the number of years that you plan to repay the loan for, the number of installments in each year. The next bit is in the total number of installments. The next bit is on the interest rate, so you'll need to put that in here. And then this will automatically calculate the monthly installments, which I will go to in a second. The first is the amount, right? So there's about 76 grand, which is required. Now, if you borrow an amount here, you'll probably have to start repaying it. So you'll probably, if you have a funding need of 76 grand, you'll need to probably borrow 100 grand to service not only this payment, but also have enough to service this. So this is again trial and error. You'll have to put those amounts in and see what comes. So let's say you need to borrow 100,000. Number of years, let's say that the loan is required or is repayable in 4 years. The number of installments in each year is 12. It's a monthly one. The total number of installments through the life of the loan is 4 into 12. So just multiply that, you get 48 installments. The interest rate is, now this is interest rate per month. So let's say your interest rate per year is 5%, simply just divide that by 12. Right, so the monthly installment is, now this is a very useful formula, so I would highly suggest that you look this up. It's minus, so you'll have to type in minus PMT, right, which is a payment calculator. Open the brackets, the rate, so select that cell, which is the interest rate, the period, which is the total number of installments during the life, and then the present value of the loan, which is this, and then close the bracket, enter, and there you go. You've got your monthly installment. So this into 48 will give you how much you're going to pay back in totality. So if you've borrowed 100 grand, you're going to pay back 110 grand at the end. So this is a very handy tool. So a lot of you I know would go online and look for payment calculators. You can do that as well. But if you know this tool, it's very easy to calculate. Now, this is monthly installment. Now, as you would know, a lot of schemes like the coronavirus business interruption loan scheme, it's interest-free for the first year. So obviously, this amount will be low in the first year because you wouldn't pay the interest in just the repayment, the capital repayment. So that's another thing to keep in mind. But on a high level, this will help you for your analysis. So what do we do now? So in terms of loan drawdown, we know that at the end of June, we're okay, but the end of July will fall below zero and we'll need some funding. So the first thing that I'll do is I'm going to put an equal to sign here and then select the loan amount. So that's 100,000 that comes into your bank account, right? The next thing is you have to show the loan repayment, which would perhaps start in the second month. So I'm going to again put equal to here and bring that and select the monthly installment. So here you go. It shows the amount coming in clearly of 100,000, and it shows the amount going back. Now, obviously the amount will remain the same for every month. So you can just select that across. Again, an easy way to do this would be to just drag that across. Right, now going back to your net flow. So as you can see, 100,000 was a magic number, and at every point of time, you've not only continued repaying your commitments in terms of cost of sales, your salary payments, your admin costs, you've also been able to service the loans. And the important piece here is come March, you're able to pay that big VAT bill, right? So that's an overview on how to build a model. Now, again, the concept that I spoke about initially is about how you to keep an eye on your balances, and it's very important not to kick the can because this only captures cash flow. So you might decide to postpone some of your opening supply payments, but there might be amounts which are still there on the balance sheet which need to be paid at a later time. For instance, you've agreed a settlement with your supplier and you've said that you'll pay this amount next year sometime. So if there's a commitment made, then I think it's very important to put that in the cash flow, but it won't really come here. So what I would suggest as a practical tip, make sure at any point of time, you calculate the balances in these accounts. So number one, your bank balance. So when you start this exercise at the beginning of every month, list down these balances: your bank, your debtors, your inventory, your creditors, your taxes payable, and your loans. So at any point of time, you'll know exactly what your net asset position is. So again, this is a rolling forecast. At every point of time, you need to keep updating the numbers. But at any point of time, you know that you might be trading from an insolvent position because your creditors are bigger than your current assets and your bank balance. So it's very important to keep an eye out on that. You know, I hope I've shown that it's actually quite easy to build a forecast. And there are just a few things. You just have to follow a structure and a proper routine to do it. And I think once it's part of your culture to build a forecast every month and keep amending it, I think you'll find this extremely useful. The next one is on the COVID-19 financial model that we put up in the Tourism NI portal. Again, what we've done is we've put a lot of guidance throughout the model, so it's a self-use one. But the warning that I would give you, the help warning, on top of everything, would be that there's no one size fits all. So every business has its own unique aspect. For instance, we've assumed that the disruption period is only for 3 months, but it could possibly go for beyond that. So use this very judiciously. My first preference would be that you make your own cash flow forecast as much as you can. But if you absolutely need to use this, then feel free to use the COVID-19 model as well. So just quickly running you through the COVID-19 model. So again, the same concepts apply. What are the receipts from customers? What are you expecting? So I'm going to put these amounts in, 20,000. There's no amounts expected here. Suppliers. Now, again, there's guidance here. So payments to suppliers, just make sure it is negative. So I'm putting that in here, 22,500. So I'm putting in some estimates here, 2,200, 5,000. Now, this tool is quite helpful, especially when you want to make a decision on a per employee basis. So I've already pre-filled some numbers here, so you can put in your numbers here. So this has a calculation, and it'll tell you what is your eligibility for the scheme. Again, this is a very high-level estimate. So depending on your pension contributions, your deductions, this amount could slightly change, but on a very high level, this would be accurate. So you can use this model. There are some assumptions on VAT. Again, there's detailed guidance here, so make sure you read that and fill that amount there. The opening balance sheet is what we spoke about. So again, just like we did previously, you'll need to put the amounts here. So just following on from the previous example that we did, so 953, there's 81,608. That's the opening balance. Now make sure the amounts here are negative. So that's 20,000 going out from your opening debtors. There's 25,000 going out in the second month and 30,000 going out in the end. And other assets is fine, 44, 924, 150. Again, there are some estimates here and here. Yep. There's a VAT payable of 78,140 and 3676. And your cash and the bank balance that you have is 58,794. And then you've got the net asset balance here. Minus 78,427. As you can see, this example is different from what we've done before. Again, if there's a debt, if you've got an existing loan or hire purchase, put that amount in here. So again, I'm going to leave it blank, but if you have a debt that you're servicing, put that estimate in here and it'll build out the cash flow for you. Now, trading after COVID-19 disruption. So this would be your best estimate on what numbers will look like in year one. So for instance, after the disruption, you're expecting to do sales of 1.2 million, put that amount in here. Cost of sales, excluding wages, would be 540,000. Your salaries and wages is 180. Oops, there's an extra zero there. And there's 400,000, 16,000 marketing costs, 20,000 depreciation, and then of course your operating profit. So this is again an estimate of what the numbers would look like afterwards. So once you put this in, this model, the advantage of this model is we've put in some VAT calculations. So what it does is it gives you automatically, it gives out the forecast that we built before. So it gives you the opening balance sheet position. It looks at all the amounts that we'd spoken about earlier, and it automatically calculates this for you. Now, the July to March is a very high level estimate. So what this has done is, instead of gradually increasing the sales and cost like we did in the early example, this just takes a divided by 12 approach. So there's an equal amount of sales, which may not be the case. So again, use this very judiciously, but at the same time, this will give you a high level understanding of, if you need a model on a very high level. This model also calculates the VAT amount automatically. So what it's done is it's automatically deferred the payment that is due in the first 3 months to the end of the year, and it's automatically calculated the VAT payment and which month it's due. So this is quite a handy tool for you. And at the very end, it'll give you the peak funding requirement and the month that it's required. So in the whole scheme of things, this 35 grand that you would need, but again, you'd need to borrow more than you need because you need to start repaying a loan. So that's one thing to keep in mind. And then, of course, you can show this to the bank and you can work out what's affordable for you in terms of a loan. Right, I think this brings us to the end of the modeling session.